Ladies and gentlemen, if you are like me, you're a Canadian, you love dividends, there's no better place to look right now than the Canadian financial sector with these Canadian banks that are yielding anywhere from 4 to 6%. A lot of these are underperforming the S&P 500 this year, and I thought it'd be fun to analyze some of the earnings that just dropped because it is a very pivotal earnings season for these banks. We had some light shown through Bank of Nova Scotia, which dropped earnings today. We noticed that Royal Bank is announced they're going to be purchasing the Canadian counterpart of HSBC for $13 billion. But we're going to quickly scan through all these banks. We're going to see the current dividend yields, the payout ratios, and how they've been so resilient through these tumultuous markets. If that's a conversation you think you'd appreciate, hit that like button because I have huge exposure to these Canadian banks through the ETF VDY. But before we get into it, folks, I also want to point out that I am analyzing a lot of the financial sectors right now because I think the banks give you good diversity through loans, wealth management, a lot of other aspects to the Canadian banking sector. But some of these really fixated, like sector-focused financial stocks like Power Corporation, which is primarily fixated on wealth management. They do own a decent portion of Wealth Simple, this big trading platform in Canada. They have been just getting hammered here. The current yield on this guy is around 6%. It's trading down about 20% year to date. And when it announced its last earnings, it got hit really bad. I mean, revenues dropped 27% year over year. Now is a prevalent time to really start analyzing these and if they are really true buying opportunities that will see some resiliency coming out of this, recessionary interest raising environment period. But take a look at MCAM Mortgage Group, another interesting financial sector that's primarily fixated on third-party loans, private lending. They get higher interest rates out of obviously these private mortgages, and this stock jumped up dramatically over the last month. I mean, it's up 30% from the recent lows, paying 8.54%. A lot more volatile of a stock, but for people looking for cash flow today, if you're in a retirement phase, I'm going to start analyzing these a lot more heavily and do a specific video, so consider subscribing for those updates. But let's talk about some of these banks. Canadian Imperial Bank. This one has stepped back 5 years in time. I can't get over that, its 5-year chart is basically flat. Year to date, underperforming the S&P 500, down 19, almost 20% here with a current starting yield of 5.16%. This thing has been a dividend beast, even among some of the larger banks here, guys. Look at this. They've increased the dividend within 2 quarters over the last year and a bit. I mean, they did a 10% raise coming toward the end of 2021, and right at the second quarter of 2022, they did again raise it 3.11%. And taking a look at the current payout ratio, guys, I mean, they're only paying up 45.58%. They have a lot of leeway in the current, market where we're going to start seeing some of these loans, some of these credit cards not get paid. There's going to be some people obviously defaulting on those, which we'll look at when we're analyzing Bank of Nova Scotia. But take a look at this because institutionally held, most of these banks are largely held through institutions. So you'd think you'd get a little more stability from the stock price, but who knows, right? And maybe these institutions are starting to scale them down a bit, holding the more resilient ones like Toronto Dominion Bank, which currently yields around 4%, down about 9% year to date, is outperforming the S&P 500, and on a 5-year basis, much more stabilized. And that's probably because Toronto Dominion Bank gives you nice diversity between Canada and the US. I think Canadian Imperial Bank is primarily fixated in Canada and on mortgages alone, whereas Toronto Dominion Bank does a lot of things. They have TD Ameritrade. I mean, they do all the same stuff Canadian Imperial Bank does, just much more diversified. And taking a look, guys, they did increase it quite a little bit coming into 2021, but or toward the end of 2021 into 2022, but they haven't increased it yet again like Canadian Imperial Bank has. So we've been getting more dividend increases from Canadian Imperial Bank, but nonetheless, these things, they all fall kind of similar in suit. Take a look because the payout ratio on this one's 43.85%, and again, held from institutions, about 57%. Taking a look at Bank of Montreal. Now, this one surprisingly has been insanely resilient. This one got hit probably of the hardest during that March 2020 crash, largely related to their loan exposure to the oil sector. And now that oil's come back so dramatically, it really rallied this stock with it. Taking a look, currently paying 4.26% with probably one of the lowest PE ratios amongst all the banks right now. And just taking a look at the dividend increases, this one has just crushed it. Unlike all the other banks, guys, take a look. Coming into 2022, the first January, basically increasing the dividend 25%. I mean, this is insane, right? And then they increased it again another 4.5% in a single year. Within 2 quarters, they increased this almost 30 freaking percent. And this is a bank, keep in mind, none of these banks cut their dividends over the last decade. It's kind of insane to think that they've been that resilient, not only through the 2008 financial crisis, the March 2020 crash. There's a reason these things are dividend kings. And the payout ratio on BMO is lower than the giant that is TD. It's only paying out 30%, guys. A lot of stability here with institutionally held about 51%. So let's take a look at National Bank. These are probably the less known banks. because they're huge. I notice I don't talk about them as much, but take a look, because this one has also been probably the best performer of the bunch, up 53% in the last 5 years, pretty much flat on the year already, paying 3.76%. And just keep an eye on these PE ratios, guys, because they're very, very low. I mean, BMO's PE right now is 7.8 roughly, which is just crazy. But taking back into National Bank, guys, let's take a look at the dividend increases. Very similar to BMO, just crushing it, baby. Look at that, 22% in January, and then again increased it another 5%. So this one's probably the best dividend increaser next to BMO. And again, these banks, guys, I mean, you go back through these histories and these dividend increases have been so damn resilient. And taking a look at the payout ratio on this one, also 34.6%. And again, mostly institutionally held, not as much as the other banks at about 35.28%. But let's talk about some of the earnings here. Bank of Nova Scotia is the first one to drop earnings. We're going to get earnings out of the rest of the banks through this week. Currently, Bank of Nova Scotia is paying about 5.86%, also very low PE ratio. And on a 5-year basis, it's been one of the worst performers, worse than Canadian Imperial. It doesn't start looking good until you get into this long chart. So this could potentially be a really good buying opportunity, because when I looked at the earnings, they actually came in line with expectations here. I mean, look at this. The EPS actually beat expectations, and basically revenues just slightly missed by like 0.38%. And taking a look before we analyze the earnings a little deeper, again, dividend increases, they've done 2 this year, not as resilient as BMO or National Bank, but again, guys, we're not talking about any dividend cuts. And from a payout standpoint, let's take a look at 47% payout ratio, and again, mostly held by institutions. But taking a look at the earnings, let's just take a look at the net interest income itself, because this is what they're going to benefit most from in the interest raising environment as time proceeds, because we can also see that these loan loss provisions have been going up quarter over quarter. Obviously, there's some fear baking into these banks, so they want to have some extra capital aside. It looks like they put $529 million aside just in this quarter alone, $412 last quarter, and then going from 2021 when everything was so resilient, they only put $168 million away. So these last 2 quarters, obviously a little bit more fear baking in, but from an interest income standpoint, guys, we can see they went from about 4.67 to about 4.62 billion. So a slight, just about nominal, just flat, considering last year they did about 4.2 billion. But if we take a look at the year end, guys, year over year, they are seeing quite a little bit of an increase of over $1 billion, which is nice to see, but this is just kind of the nominal environment we're living in. I think this will increase as the economy continues to come back. Their international banking, super resilient here. I mean, take a look at this, because we can see their net interest income, guys, basically went from 1.75 billion last quarter to 1.8, and over last year it was 1.58 billion. So they're definitely seeing a really nice, healthy increase from the international standpoint, with a lot of exposure to Latin America. That's kind of like their international exposure for Bank of Nova Scotia. But taking a look at also what's really fascinating data to me, guys, is basically the income in their total assets, because this is where we can actually see the loans outstanding. And let me zoom this in so you guys can see this crystal clear. So residential mortgages currently make up, and again, we're just going to be taking a look at the last quarter here from quarter over quarter, and just take a look at this, because residential mortgages went from 343 billion to 349 billion, which is quite astonishing considering this time last year they only had 319 billion. So there's still a lot of mortgages growing on the bottom line. Personal loans, we can see actually continue to increase here. Taking a look at credit cards, these have actually been increasing. Business and government, guys, so I can imagine they're doing some loans for, businesses and government, have also been increasing. So across the board, people still getting out in debt, man. People still taking loans. This will only bode better for them if they can survive and continue to do well like they have been in these last few quarters. This earnings was actually very, very resilient. Royal Bank here, guys, which is going to be posting earnings tomorrow, we can see is probably one of the higher PE ratioed companies, because it is Canada's largest bank. So it's no surprise that it has had some of the most stability. Toronto Dominion Bank, Royal Bank, they're really heavily exposed in these ETFs that I buy. So they're my 2 most exposed banks. And I think the ETFs are honestly what offer the most stability, because anytime people like me cost average into those ETFs, they do end up just trickling to these top weighted banks. So that's why you get some of the more resilient, stability and less volatility out of the stock price itself. And Royal Bank paying a current yield of 3.85%. Just taking a quick look at this, guys, we can see that they also increased it twice, pretty much within the last few quarters since the beginning of 2022, which is pretty nice to see. Again, not as much as BMO or National Bank, but we're not complaining here considering how stable the stock price has been itself. And taking a look, payout ratio 43%, 48% held by institutional funds. And Royal Bank, big news, this is really going to boost their earnings. This is probably absolutely incredible for us holding Royal Bank or having major exposure to it, is this HSBC of Canada, this $13.5 billion deal. They're purchasing 130 branches across Canada. Apparently, Royal Bank Canada has agreed to buy the Canadian arm of multinational bank HSBC. RBC Chief Executive Dave McKay said that the deal offers the opportunity to add complementary business and client base. This also positions us as the bank of choice for commercial clients and international needs, newcomers to Canada, and affluent clients who need global banking and wealth management capabilities, which is pretty incredible because I think Royal Bank has primarily been fixated in the Canadian sector. They're kind of wanting to get some of that global exposure because, that's what TD has. They're very exposed to Canada, the US. Most of these banks are trying to expand internationally because they're seeing that growth again, like we're seeing at a Bank of Nova Scotia. So this deal is going to be massive. And I think we're going to start seeing it hit within the next couple quarters. So 2023, we should start seeing a pretty nice increase here. They posted an operating income of more than 1.1 billion in the first half of this year alone. So do expect to see a really big revenue bump coming out of Royal Bank because of this recent purchase. But I want to pass the question off to you. What do you guys think about the Canadian banking system? Obviously, I think every Canadian should buy them like Pokemon cards. You kind of just got to collect them all, hold them forever. I don't really think there is more resilient Canadian dividend stocks than out of our Canadian banks. But let me know what you think in that comment section below.